In 1957, a group of 8 scientists needed capital to build silicon transistors. Traditional banks aggressively refused to lend to a company with absolutely no hard assets, no existing revenue, and a completely unproven commercial product. A young financier named Arthur Rock convinced an industrialist to back them, exchanging cash for an ownership stake rather than issuing a standard debt note. This single, highly speculative transaction birthed Fairchild Semiconductor. It also ignited a specialized financial engine that would eventually build the entire modern digital world. The fundamental problem of radical innovation is that the future is inherently uncollateralized. Commercial banks require physical assets, like real estate or heavy machinery, to secure their loans, making them entirely useless for software developers or hardware pioneers, building entirely new paradigms. Brilliant, world-changing ideas frequently starve in an absolute vacuum of capital. Bridging the massive gap between a high-risk conceptual technology and a profitable commercial reality requires a completely different mechanism of funding, one that embraces extreme uncertainty. Early-stage venture capital emerged to fill this critical void, fundamentally altering how financial risk is priced, absorbed, and rewarded. Instead of charging a fixed interest rate on a loan, these specialized investors purchase equity in a nascent company. They fully accept that the vast majority of their investments will fail completely, returning nothing. The entire economic model relies on the statistical probability that one colossal success will generate returns massive enough to cover all the inevitable losses across their portfolio. This extreme power law distribution dictates the brutal, uncompromising mathematics of startup funding. Venture capitalists are never looking for steady, incremental growth or modest, reliable profitability. They hunt exclusively for massive outliers capable of disrupting and monopolizing entire global sectors. When they evaluate a founder, they are assessing the potential for a multi-billion-dollar valuation, pushing companies to scale at a breakneck pace to capture market share before traditional competitors even realize the race has begun. Silicon Valley quickly became the geographical epicenter of this high-stakes financial ecosystem. The close proximity of Stanford University, deep and highly specialized pools of engineering talent, and a unique regional culture that actively destigmatized professional failure created a powerful feedback loop of continuous invention. Capital flowed heavily into the region, attracting increasingly ambitious founders, which in turn attracted even larger pools of institutional money looking for exponential returns that public stock markets simply could not offer. The resulting explosion of software and hardware completely rewired daily human existence on a global scale. The powerful smartphones in our pockets, the dominant search engines organizing all human information, and the massive social platforms connecting billions of people were all heavily accelerated by this specific financial catalyst. Without the unique willingness of early investors to absorb massive initial losses in exchange for future equity, the complex infrastructure of the modern internet would have remained largely theoretical. This aggressive, relentless pursuit of scale eventually triggered one of the most spectacular and destructive financial events in modern history. By the late 1990s, the utopian promise of the internet drove a blind, speculative frenzy, pouring unprecedented billions into almost any company with a web address. Traditional valuation metrics like actual revenue and sustainable profit margins were entirely abandoned in favor of tracking raw user growth and theoretical future dominance over digital markets that barely existed. The resulting dot-com bubble violently corrected when the speculative capital simply ran out. The historic crash wiped out trillions of dollars in market value and bankrupted thousands of newly minted tech companies in a matter of months. Yet the underlying physical infrastructure they built, specifically miles of dark fiber optic cables laid across the ocean floor, remained fully intact. This abandoned, heavily discounted architecture drastically lowered the cost of launching the next generation of digital platforms. The battle-tested survivors of that crash learned to build significantly leaner, more financially resilient business models. The baseline cost of launching a new software company plummeted from millions of dollars to mere thousands, driven heavily by the rise of cloud computing and open-source code. This drastic reduction in initial capital requirements shifted the balance of power, allowing founders to thoroughly prove their concepts and gain traction before giving away large percentages of their company equity. Venture firms quickly adapted by restructuring their investment stages to match this new, highly efficient reality. They began deploying much smaller amounts of money in initial seed rounds to test a wide and diverse array of ideas with minimal risk. Once a specific company demonstrated clear product-market fit, the firms would then pour massive, unprecedented amounts of growth capital into subsequent funding rounds. The clear objective was to build an insurmountable financial moat around the business before taking it public. An IPO exit, or initial public offering, serves as the ultimate liquidity event for both the startup founders and their early financial backers. Transitioning from a closely held private startup to a heavily regulated, publicly traded corporation allows venture funds to finally sell their shares, returning massive cash profits to their own limited partners. This critical mechanism unlocks the trapped wealth, distributing it back into the broader financial ecosystem to fund the next inevitable wave of technological innovation. The sheer scale of these exits grew exponentially following the 2008 financial crisis, driven largely by unprecedented central bank interventions. As global governments implemented quantitative easing, a monetary policy where central banks purchase long-term securities to increase the money supply and aggressively encourage lending, interest rates dropped to near zero. Institutional investors, desperate for any meaningful yield, flooded the venture asset class with massive amounts of cheap capital, fundamentally changing the dynamics of private markets. This historic flood of liquidity fundamentally distorted the traditional historical timelines of corporate maturity. Startups that would have historically gone public to raise necessary growth capital could suddenly stay private for a decade or more, armed with valuations reaching $13.8 billion or higher. These tech giants aggressively subsidized consumer costs, operating at massive, calculated losses for years to systematically dismantle legacy industries like transportation, hospitality, and traditional media broadcasting. For the everyday consumer, this specific era felt like a golden age of highly subsidized luxury and unparalleled convenience. Ride-sharing applications, instant food delivery services, and vast streaming platforms were artificially cheap, directly paid for by venture funds prioritizing rapid user acquisition over actual sustainable profitability. Millions of people unknowingly built their daily routines around digital services that were fundamentally disconnected from the actual physical cost of providing them eventually. The massive bill for this growth at all costs strategy always comes due when macroeconomic interest rates inevitably rise and the flow of cheap capital abruptly tightens. Private markets demand a harsh pivot from rapid expansion to actual, verifiable cash flow. Companies are suddenly forced to raise consumer prices, cut labor costs, and aggressively monetize their captive user bases, suddenly exposing the fragile, highly vulnerable economics underlying their seemingly invincible digital platforms. This intense market pressure reveals a stark contrast between venture equity and other more traditional financial instruments. While a derivative is a complex financial contract whose value is entirely reliant upon an underlying asset like a stock or a physical commodity, early-stage venture capital is a direct, highly illiquid bet on human execution and unproven technology. There is absolutely no underlying tangible asset to hedge against. If the startup company fails, the equity simply goes to zero. Despite these inherent structural risks, the venture funding model continues to aggressively push into increasingly complex, capital-intensive sectors far beyond simple consumer software. The primary focus has decisively shifted toward artificial intelligence, advanced biotechnology, and automated manufacturing. These deep tech industries require significantly more upfront capital and substantially longer development timelines, severely testing the patience and the structural limits of traditional 10-year venture capital funds. To successfully navigate these highly capital-intensive frontiers, forward-thinking venture firms are heavily prioritizing supply chain resilience, investing heavily in startups dedicated to fortifying the global flow of physical goods against structural disruptions. By funding companies that build advanced robotics, localized microfactories, and predictive logistics software, investors are actively trying to insulate future critical technologies from unpredictable geopolitical shocks and international trade bottlenecks. This massive strategic shift aligns with broader regulatory and societal pressures currently reshaping exactly how institutional capital is deployed globally. Many large limited partners now strictly mandate ESG investing, a framework requiring capital to be allocated based on environmental, social, and governance factors alongside traditional financial returns. Venture funds are consequently directing billions of dollars into next-generation clean energy grids, atmospheric carbon capture technologies, and highly sustainable agriculture platforms. The integration of these massive global challenges mean venture capital is no longer just funding convenient consumer apps. It is attempting to literally underwrite the future infrastructure of human civilization. The exact same financial mechanics that once built simple web browsers and search engines are now being applied to commercial nuclear fusion, orbital space logistics, and advanced genomic sequencing. The stakes of success and failure have aggressively escalated from digital convenience to planetary survival. Yet the extreme concentration of this financial wealth and decision-making power remains a point of intense, ongoing friction. A remarkably small geographic area and an incredibly insular network of financiers effectively dictate which emerging technologies receive the vital fuel to exist and which are starved of resources. This severe bottleneck of capital allocation raises profound, unavoidable questions about who ultimately designs the future and exactly what financial incentives drive their blueprints. The specific technologies that manage to clear this financial bottleneck inevitably reshape the broader labor market and completely redefine human productivity. When a venture-backed enterprise automation platform successfully scales, it does not merely disrupt a legacy competitor. It fundamentally alters the earning potential and daily tasks of millions of working-class people. The ripple effects of a single private investment committee's decision can dismantle entire local economies while creating entirely new, highly concentrated wealth centers elsewhere. Looking back at the historical evolution of this unique asset class reveals a continuous, unavoidable cycle of boom, bust, and structural reinvention. From the early silicon transistor pioneers of the 1950s to the artificial intelligence architects of today, the underlying financial mechanism remains remarkably consistent. It is a system specifically designed to weaponize financial risk, converting massive amounts of capital into highly concentrated bursts of technological and societal acceleration. The massive tech giants that currently dominate the modern global stock market are the ultimate undeniable products of this highly specialized financial engine. Their unprecedented historical market capitalizations, often spanning trillions of dollars, completely validate the core thesis of high-risk venture investing. They stand as enduring, monumental proof that a single aggressively funded outlier can redefine human behavior globally and generate enough wealth to justify thousands of forgotten, failed experiments. As the global economy fully enters a new era, defined by constrained physical resources and increasing geopolitical fragmentation, the role of this specialized risk capital becomes even more critical. The easy, highly profitable victories of consumer internet software have largely been won. The next generation of ambitious founders must solve significantly harder physical and scientific problems, requiring investors to fully embrace deeper technical risks and much longer horizons for their inevitable liquidity events. The complex machinery of early-stage funding will undoubtedly continue to evolve, adapting to new macroeconomic realities and rapidly shifting technological frontiers. The relentless, highly incentivized pursuit of the next paradigm-shifting breakthrough ensures that massive capital will always seek out the most ambitious ideas. Understanding this specific financial engine is absolutely essential, because the private companies it quietly builds today will undeniably dictate the public economic reality of tomorrow.